Welcome back to Alpha Recap. Today's episode is a post-market deep dive on what moved markets on March 6th, 2026. I'm glad you tuned in. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to unpack from the tape. Rumors, rotations, and a reminder that geopolitics still bites when you least expect it.
Let's start with the biggest headline of the day. A resurgence of optimism in the cannabis sector, tied to circulating rumors that Pam Bondi's team finalized a rulemaking package to reclassify cannabis to Schedule 3. Walk us through why that sent retail traders and options desks into a frenzy.
So, what really stands out here is the potential scope. Rescheduling to Schedule 3 is not a minor tweak. It signals federal recognition of medical use and a lower abuse potential than Schedule 1 or 2. That changes the math for banks, tax treatment, institutional capital, and research access.
Right, and the markets reacted immediately. Retail flows picked up and option activity rose in cannabis names. It looked like a headline-driven rally.
Exactly. Traders were saying the package had been through extensive legal review, calling it bulletproofed. If that claim is true, it would lower the odds of successful court challenges that have blocked past efforts. But, and this is important, the rule is still a rumor until regulators publish the notice.
Hold on, say that again. Bulletproofed?
Yeah, some market chatter described it that way. Traders used that language to justify higher probability pricing. But past attempts have been derailed by courts or political shifts, so treating it as conditional is the prudent play. If the change actually landed, the practical effects would be big. Banks would feel easier about servicing cannabis businesses, which would reduce cash management burdens and open credit lines. Tax treatment under the tax code could shift. Right now, Section 280E prevents normal business deductions for controlled substances, so rescheduling could materially improve after-tax margins, though the IRS and Congress would still have roles to play. And institutional investors and federally funded researchers would face fewer barriers to entry.
So this is a potential structural reallocation catalyst, not just an industry tailwind.
Yeah, that tracks. It could ripple into regional banks that have exposure, into credit markets, and into real estate investment trusts with cannabis tenants. But again, rumor versus confirmed rulemaking is the critical distinction.
Let's pivot to another major thread: AI infrastructure and concentrated quality growth. Jensen Investment Management's fourth quarter investor letter came up a lot today. You want to frame the key call there?
Jensen leaned into the thesis that certain suppliers and platform leaders are the fulcrums of the AI build-out. They highlighted Broadcom as a crucial supplier at the silicon and connectivity layer, and they reiterated conviction in Microsoft and Alphabet as durable, quality growth names because of cloud, platform reach, and recurring monetization from AI adoption.
So the takeaway is allocators are tilting toward companies that power the compute stack and the cloud platforms that monetize AI broadly?
Exactly. The idea is that data center compute utilization stays elevated, and suppliers with scale and pricing power benefit disproportionately. Microsoft and Alphabet are seen as monetizing AI features across ad, cloud, and enterprise software, creating sticky revenue streams.
Yeah, absolutely.
But there's a flip side: concentration risk. Some strategists warn that piling into a handful of names raises single point of failure risk. Think regulatory action, semiconductor cycle swings, or a slowdown in AI demand. So conviction needs to be married to liquidity planning and crowding analysis.
Brief reaction? That sounds like a classic reward versus risk setup. Another daily pattern. We saw headline-driven micro moves and routine filings move individual stocks. Anything noteworthy there?
Yes, trending tickers like those in semiconductors, retail, and airlines popped in the chatter, and a cluster of 8K filings from smaller companies drove idiosyncratic volatility. Corporate events still matter. Orexo announced an R&D day for March 24, 2026, which is a classic setup for event-driven traders.
Got it. Now, one of the sobering themes was geopolitical risk. Morgan Stanley's line about an everybody loses scenario in the wake of the Iran conflict. Walk us through what that implied for correlations and diversification.
The headline was blunt for a reason. In stress episodes, asset correlations can spike, which breaks the historical diversification cushion many portfolios rely on. Bonds, equities, and alternative assets that usually offset each other may move together in a crisis, reducing the effectiveness of passive diversification. That forces a rethink, either active hedging or structural changes to allocation models.
So portfolio managers who leaned on historical covariances could be underestimating joint tail risk.
Exactly. Quant teams need to revisit correlation matrices and stress scenarios. Active managers might prefer tactical hedging, while others might hold optionality in cash or options rather than wholesale repositioning.
Short reaction, not comforting, but pragmatic.
Right.
Let's touch on the defensive versus growth dichotomy. Motorola Solutions got framed as a defensive, recurring revenue name, while Eli Lilly continued to benefit from secular biotech tails. How did the market reward those different profiles?
Investors moved toward stability and compounding growth at the same time. Motorola Solutions was presented as mission-critical, predictable cash flows, appealing to income and defensive investors. Eli Lilly edged higher on multiple tailwinds, which reinforced investor appetite for secular winners in pharma alongside AI beneficiaries. The market was basically saying both safety and long-duration growth have a place, and that creates allocation dilemmas.
So committees are juggling competing priorities: preserve capital or chase secular upside.
Yep, and that ties back to the earlier point on concentration. If you overweight a handful of AI infrastructure names, you have to plan for what happens when liquidity dries up or sentiment turns.
Let's be concrete for different investor types. What were the practical implications you'd give retail listeners?
Short term, retail saw increased volatility in cannabis names. Day trading and swing opportunities popped up, but rumor-driven moves carry headline risk. Size positions. Consider stop losses or collars and avoid overpaying on unconfirmed policy shifts. Long term, watch for regulatory confirmation and the final rule text before making large commitments.
And for institutions and fiduciaries?
Institutional committees should run scenario analyses that incorporate rescheduling outcomes, changes to tax rates, cost of capital, and bank access. Also, explicitly model crowding risks if reallocating to a few AI enablers, and update governance for politically sensitive sectors.
Active traders and quant funds?
Event-driven desks should monitor regulatory dockets and 8K filings for timing clues. Options markets may misprice tails in cannabis and across AI supply chains. Quant shops must revisit correlation assumptions, particularly given the Iran conflict's potential to change the correlation regime.
Defensive and income-oriented investors?
Look at mission-critical names for predictable cash flows and consider flexible fixed income or structured hedges if correlations remain elevated. Traditional bond proxies might underperform as hedges in a regime where everything moves together.
Before we wrap, give listeners a playbook. What actionable steps should investors consider right now?
Treat the Schedule 3 story as conditional and scale in as official notices appear. For AI conviction bets, plan for liquidity and crowding. Position sizing and stress tests are essential. Reassess diversification assumptions and increase emphasis on active hedging tools like tail risk protection and cross-asset options. Monitor corporate event calendars and 8Ks for tradable catalysts. And keep a 2-track playbook. Defend while participating, hold secular winners, but keep dry powder and bespoke hedges to exploit dislocations.
Honestly, I was a bit surprised by how many themes intersected today. Policy rumors, structural AI bets, and rising geopolitical correlation risk all at once.
Yeah, it's one of those days where conviction is valuable, but discipline matters more.
All right, let's close with quick takeaways for listeners.
First, the Schedule 3 rumor could be transformational for cannabis, but it was still unconfirmed. Trade it as conditional. Second, AI infrastructure and cloud platforms remain the center of professional conviction, but concentration risk is real. Third, geopolitical stress is changing correlation dynamics, which reduces the reliability of passive diversification and raises the value of active hedging. Fourth, corporate filings and event calendars continue to be reliable short-term catalysts.
Perfect. If you want to revisit anything we covered, our notes and linked resources will be on stockalpha.ai. And if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. See you next time.